Good afternoon, everybody. Good afternoon. Good afternoon. This is Stephen Padernacht with the Padernacht Real Estate Team. And again, we are here with another episode of Mortgage Matters, where we deep dive into all of the intricacies of navigating a home sale through the lenses of a financial expert. I have with me my co-host, Christian Babcock from the Loan Depot, who I will be adding to the screen right now. Hey, Christian, how you doing?
I'm doing well. How are you?
I'm doing great, doing great. Happy Friday to you.
You too. You too. I
Oh,
changed
I
changed
see
my
where you
camera.
are. I see where you are today. You are in your office.
Yeah, yeah. I'm a little blurred out today. So I changed the camera too, so now you can see, my imperfections here. Yeah.
Oh, wait, so you got a new camera? Yes, it does look clearer.
Yeah. I got to change that. I got to work on the settings here.
All right. Is it? I imagine that this is probably the first time that you're using the camera.
Here at this location, I've used it in my White Plains office location. You've seen it there. So,
Gotcha.
yeah, we're
Gotcha.
getting there. You're getting
All
there.
right, man. Listen, little by little, right?
Yeah, that's it.
Little. So, how's your week going?
Good. How are you?
I'm doing good, doing good. I mean, there's just so much activity right now, surprisingly, with the, obviously the big R word, the rates where they are. There's still a ton of activity, man. I'm seeing it, like offers are going, offers are coming in, homes are selling over asking price.
Mm-hmm.
And there's just a lot of activity, and I'm just very, very, very busy, which is, busy and blessed, right? Like, my dad used to say, are you doing busy work or productive work?
Yeah.
So
Yeah. That's
being very productive.
Exactly. Being busy and productive are two totally different things for sure. So I try to be as productive as I can in every day also. And, being able to time block and delegate and all that stuff becomes part of that for sure.
Yeah. The whole working in your business or working on your business, right?
Mm-hmm. That's right.
How do you balance the two? How do you balance between leading people and getting the job done with the tasks that you have at hand?
Delegating. I mean, is being able to know which specific tasks are worth my time versus somebody on my team. So if it's something that I can pass off that one of my team members can handle, and focusing on the things that are just going to make me more productive on a day-to-day basis, it really comes down to delegation and being organized. And knowing what to delegate, who to delegate to, and then sifting through all that stuff.
Do you have like weekly meetings set up with your team just to kind of check in to see where they're at?
Not as often as I used to, because we're so kind of finely tuned right now. Everybody knows what they should be doing and are doing. So I don't have to really micromanage as much as I used to. I mean, most of the people that are working with me have been for me for 10 years or more. So we really have a good system going.
Good. Well, hopefully this year will springboard both of us and everybody around us into, uncharted courses, right? And crack through the ceilings that we've, sort of self-imposed on ourselves.
That's right. So, and then we are, because we're in the Northeast, it's a very seasonal business. So we are in the season right now, which is why you're seeing a lot more activity for sure.
Yeah, absolutely. And I think, I brought some slides with us just to kind of talk about it. And I think one of them has I'm not sure if I added or not, but if you look at home sales over the course of a 12-month year, like you see the big, you're going kind of steady. And then all of a sudden, boom, you hit this big bump for like 3 or 4 months, and then you start coming back down.
Yeah. I mean, spring and summer has also been a sweet spot in our business. Properties show better in the spring and summer, so, you're not trudging through a foot of snow to go see a house. So people are just more active in the spring and summer. So this is our busy season for sure. Fall, we definitely see a big push in the fall. Also after summer vacations, kids getting back into school. We usually see another push like towards the end of September up to Thanksgiving. So
it's interesting the way the seasons kind of dictate, how it's going to go, right? Like you said, like after it's like summer vacations, everybody's kind of like not really in the mindset. And then once you come back in the fall, it starts rising again.
Yeah. Yep.
I've always. What's your opinion on the spring season and why it's such a busy time?
It's the weather. That's it. No. Yeah, as I was saying, properties show better, landscaping starts to pop. I mean, houses, curb appeal, all those things. Houses just they show better in the spring and summer months. So historically, it's always been busier. Now, with with technology and everything else helping, we've definitely seen in the last few years more sale activity in this like in the winter, than probably previous years before you had so much technology at people's fingertips, the Zillows and the Trulias of the world and everything else where people can see listings the minute they come up,
Yeah.
do virtual showings, stuff like that. I mean, there's a lot of technology that kind of helps it to be less seasonal, but it still is very seasonal.
The technology aspect really, when I first started, when I first started 2004,
Mhm.
there was none of this stuff. There was no, like if you had like I remember when like when virtual home tours like became a thing, and it was like and even just to kind of go back a little bit further, like I remember, I don't think I was licensed at the time, but I remember my dad, he used to get like a booklet of all the listings that came out.
Mhm.
And
Mhm.
like people would come in and they'd say, okay, oh, let's look at this one. Let's look. And then you'd have to go drive to the broker's office, grab the key, and then go show the house.
Yeah, yeah, yeah. No, 100% right. I mean, the internet was the first big shift in that. I remember when Zillow first started, and agents would advertise their services to potential sellers to say like, "Hey, you want to work with me because I have Zillow, I have Craigslist, and when I list your property, I'm going to manually put it in those
Craigslist.
websites. I'm going to manually do all that stuff, so you're getting all this internet exposure when the internet was like really so new."
Uh-huh.
Now that stuff just gets, as soon as it hits the MLS, it's like boom, it hits 20 different websites automatically. So it's
One other thing that I just remembered, it just popped in my head, was the New York Times. Every Sunday, they would put out. And my dad did more commercial real estate, so like on Sundays, he would go early in the morning, grab the New York Times, and
Mhm,
Sunday was a busy day. Like it was a work day because that's where all of the people advertised all the multifamily, all the commercial stuff. And
yeah,
anybody who was anybody, that's where you advertised in the New York Times. So you'd spend the whole day. He would literally spend the whole day there. And I was there with him, like calling people up. Okay, so I'm calling about this property. Do me a favor, fax it over to me. Let me
yeah,
take a look at the let me take a look at the setup on.
yeah, 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 yeah. No, I mean, that was the main source of advertising was newspaper ads, and
Yeah, yeah.
it was a penny saver.
Yep.
Penny saver had real estate ads in it. You know,
Yeah,
so
the local papers aren't bad though. Still, like like the Riverdale Press still gets a decent amount of people that advertise in it. And those are like a lot of times they tend to be like the old timers that kind of want to stay off the grid, so to say. So I found some success there.
mhm.
Just reaching out to sellers there and not necessarily getting a listing, but having the pocket listing where, like, if I had somebody looking for something off market, I could offer it to them.
Right, right. Yeah, yeah. No, I still see a lot of in smaller local papers, a lot of local brokerages taking out entire, one-page ads with their listings. And it's
Oh
good.
yeah,
It's
yeah.
more branding than anything else now, though. It's like, I don't think they're really anticipating selling a house off one of those ads, but it's more just branding
Yeah,
at this
because
point.
they want to be able to point to it when they're going on their listing appointment and say, look at the exposure that you could possibly get.
Right, right, right. Yeah, it's really branding.
Talk to me about some mortgage news. What's going on this week?
It's been kind of bumpy this week. I mean, rates went up a little bit in the beginning of the week. We're starting to see them tail back down towards, yesterday and today. So, I'm seeing like an eighth or quarter% shift upwards in the beginning of the week. And now we're getting that kind of same quarter back. So we got a good inflation read today, which really was, when I say good, it was just kind of matched expectations, which is good. So we're not seeing a spike in rates, but higher than inflation number. So it's been a pretty, coming off the Memorial Day weekend. It's usually a slowish week for new activity, but so it should be picking up again soon. But
Were
rate
there
wise,
any were there any
mhm.
reports that came out this week?
Yeah, the inflation PCE report came out this morning. That's the one I was just referring to. That came
Oh, okay.
out, kind of as expected. So again, we're hoping for more data that continues to come out in the next month or so. Seeing signs of inflation cooling. I don't think anyone's expecting dramatic change, but as long as inflation is not increasing month over month, I think we can see relatively stable mortgage market, maybe even some decreases in the next couple months. So we'll see. Keep fingers crossed. I mean, they did, they breached 7% again for a day, and now we're back under 7% again. So on a, again, on an average 30-year fixed.
Of course, yeah.
But yeah, it's, status quo for the moment.
Okay. Well, I mean, look, I think that stability is what people are really looking for. And as long as they don't keep going up,
right,
up to be unattainable, I think it will keep the market where, it's at least there's going to be activity.
Right, which is just what you're alluding to. We're seeing that. I mean, I'm seeing it every day. I'm seeing people still putting in offers in way above asking. Yeah, still not getting the properties. Major, super competitive market right now in pretty much everything, even co-ops. I have a guy that's looking at $150,000 to $200,000 co-ops and getting outbid on everything. By a lot. It's like, and then $2 million houses, same thing, $100,000, $200,000, $300,000 over asking and still not getting them. So it's fiercely competitive. Definitely, again, for the new buyers out there, don't be discouraged. I've seen, people, I've just had an accepted offer come through on a VA loan that we're doing with 100%
Nice.
finance.
Yeah. I love to hear the VA loans getting offers accepted. I love that.
Yeah, so yes, it's really just how it's positioned. I've seen agents try to discourage people from using VA, and that's just not a good look. Especially that I'm doing a good amount of VA loans in the last couple of years. So, and as a company, a lot. So they're definitely getting accepted offers. It's just a matter of how it's positioned and how the offer comes through.
The VA loan is one of my favorite loans when I hear people have the VA loan, and only literally from the perspective of like doing something good for the people who, just coming off of Memorial Day, right? And Memorial Day is more so for the soldiers who didn't make it home. But, the VA loan is geared for people who sacrificed their or risked their lives for us. So why not try to do something good for them?
Yeah. And again, surprisingly, you'll see home sellers that want to give it to a veteran. So that's what I mean. Like, they shouldn't be getting discouraged by using the benefit. It's an amazing benefit for veterans. And I think if it's proposed the right way to a seller, they would want to help, as long as they feel confident that the mortgage is going to close. I think, in some cases, they'd almost rather choose the veteran over, another home buyer potentially.
Mm-hmm. All right. So just switching gears a little bit, I alluded to this, but I have a couple slides I want to just kind of use as a conversation piece. So just give me a second. I'm trying to see which one I have here. Let's pick this one and see what it does. Let's see what this is.
Well, it's busy.
There you go. Okay. All right. So here you've got, and these slides come from Keller University. They do the research and they supply them to all the agents here in the office. And, I thought it was, very interesting just looking at this historically and kind of wanted to throw it to you a little bit and tell me what your first instinct is when you see something like this slide here.
Well, I mean, it's going way back, way back then you and I existed.
Yeah. Yeah, we're going back to April 1959. So why don't we focus on like 90? Well, listen, I think 82 is a good number.
Yeah, I mean, 82 is a good number because it's like, the buzz in terms of comparing where we are now, in terms of inflation, but we're not even nearly as close mortgage rate wise to where they were in the 80s. I mean, a lot of people will say, like I remember when my parents bought their house in 81, their rate was 17.5% and they had to put 50% down. But they paid $100,000 for the house. As in that house today is probably $700,000-800,000 house. So, when you look at the appreciation in one lifetime, that's one family's lifetime from buying a house in the 80s to where it is now. I mean, when you look at the actual appreciation is, unbelievable. But, when you look at a trend, when you look at a line like this, you see that it's not a consistent, line going, trending upwards every year. There's ups, there's downs, there's, every market kind of in between. The big one here is obviously the mortgage crisis and the Great Recession. You could see that. I mean, on this line where you're looking at, the line going straight across is really at zero. So
Yes.
prior to that, there was a 14.5% appreciation. And then when you look at that downward 12.75% in February of '09, when you add those two numbers together, that's really 26% downturn, because it went down from the 14.5 and then down another 12.
Yeah, exactly. So if you're at 100,000 in September of '05, you're going all the way down. You're losing 25% of value.
Right.
So your house just depreciated, down to 75K, in the matter of like a couple of years.
Right, and that was a very, very difficult time. We were doing a lot of short sales at that point. For those who don't know what a short sale is, if you look at this graph, if you look at September of '05, if somebody bought a house at the peak of the values there, and say paid $500,000 for the house, if they depreciated down to say 450. But if they financed the whole 500, which a lot of people did,
Yes.
there are times you were able to do 100% financing, or even more in some cases, 106% financing. Those people were underwater on their mortgage very fast, which means they owed more than what they were able to sell it for.
Yeah.
So they owe 500, they can only sell it for 450. That's what triggers a short sale. A short sale, basically, by definition, is that the bank they're selling it short of what they owe. So if they owe if they owe 500 and they're selling it for 450, there's a $50,000 gap in there that has to typically sellers should be paying in cash.
Yep.
But if a seller
they were doing
have that cash, then they have to petition the bank that owns that loan to sell it, to allow them to sell it short and forgive that 50,000.
Yeah, so let's just go backwards just a step, right? Like to get to that point, right? So like in 2008, 2007, or up to that point, they were doing a lot of these no-doc loans, and they were doing a lot of financing where the borrowers were putting down very little, and they were just approving loans. So your average buyer, doesn't, and they didn't have the income. They weren't really seeing the income.
Right.
So I could go to you and say, hey, Christian, I could have gone to you and say, hey, I want to buy a $500,000 house. And you would say, okay, supply me with a little bit of paperwork. And then you'd push it right through. Now, all of a sudden, I fall behind on my payments. And then it goes into the factual part of what you're saying. We're like, okay, I fell behind my payments. I'm like, all right, I want to give the house back, or I want to sell the house. Well, the house is only worth 450 right now, but you owe 500. Then I go to the bank and I say, well, what can I do? And they say, all right, well, at that point we could do a short sale, and the bank basically takes it back and puts it on the market for whatever value they could get. But it started back when the people were just giving these loans to people who weren't qualified.
Right. Exactly. And there was really no regulation in the mortgage space for, different investment banks or, investors to create their own mortgage products. And it really just got out of control. And really where it's relevant today is that, because I hear people comparing, this market with that market.
I know exactly where you're going with this. Yep.
And it's just not the same, because that market was propped up by bad mortgages. So when those mortgages failed, you had a rush of inventory on the market, which, has caused more supply than there was demand, which causes prices to go down. It became, and when you look at the absorption rates, that your office puts out all the time, some of the towns in the Bronx and places like that, they had 24 months of inventory some places, where in those same areas right now have maybe 2 months of inventory, which triggers a fear selling market. So the turnaround, when you look at, when that was going down to where we are now, it's a long period of time. It's almost, it's almost 20 years if you really look at it. That it's like 15 years, but look how much the market has bounced back in that time.
Yep.
Now, we're not seeing a bubble right now. Now we're seeing the result of supply and demand. There's just still not enough supply to meet the demand in most areas because of the pandemic. The pandemic, it was a mass exodus out of a lot of cities. And all the outer suburbs and all the areas in and around the cities were essentially oversold. I've said it in previous episodes where, we're used to a certain amount of people coming out of New York City every year, coming into the outer suburbs and counties in the Bronx and everything else. You had probably 10 times that amount come in a year and a half. And they bought, sold, rented everything that there was to buy, sell, or rent. Now we're seeing kind of the snapback of all that overselling because those people are not selling those houses.
And just at a caveat, they were buying them at 2 and 3%.
That's my point. Right. So 2 and 3%. Now they're staying in those houses, or if they move back into the cities, they're keeping them and renting them out. Because
Yeah.
now they're making a profit because rents are up and they got a 2.5% rate and somebody else is paying their mortgage. So why would you sell, So there's so many factors that are causing the inventory shortage right now. That's just really one of them, which is also causing still significant appreciation. And because people can afford the loans, we're not propping this market up with bad loans. Every loan is fully documented for a primary residence. We're getting pay stubs, we're getting tax returns, we get all the things that we've talked about on previous episodes. So people can afford the mortgages we're giving them, even at these high rates. They don't like it, and they're probably planning on refinancing that, in the next couple of years if rates come down 1 or 2%, but they can still afford it.
Yes.
And that's why we're not seeing really any correction in price right now in most of the areas. Some areas throughout the country are seeing it, but not locally here in where we are.
I find it very interesting just to kind of go back a little bit here. And I know we started at 82, but if you look at like 1973 oil crisis, I don't even really know what that was, but you see how from there it jumps up to this stagflation of the mid 1970s. Not too sure what that is, but now you got inflation all the way. Once inflation on its way to an all-time high, it's these events, and really where I was getting at was these events in society are what's driving the housing market, and we are so dependent on these activities. And this is just kind of like to other agents and to other people that are in the industry, like you have to stay up on current events and what's going on. You can't just be completely blind to it, because if you want to be one of the best realtors, if you want to even just give the least amount of knowledge to your clients, you have to kind of be aware of these things and how they affect your business.
Yeah. Oh yeah. As a real estate agent or in my business, 100%, you can't not be listening to current events on a daily basis and knowing what's going on economically and how that's impacting the market. And especially when you have a client that is aware of all those things and you're being asked those questions, you can't field those questions. They're gonna move on to somebody else who can. Yeah.
Well, that's why these calls are so valuable to me, Christian, honestly, just to be able to bounce some ideas off you for a half hour every week and kind of get some real-time feedback. It helps me tremendously with my clients,
Yeah, totally. So, but again, it's an interesting, it's really an interesting history, all through all those major events, there's been changes in policy, on the federal level, local levels, everything else, changes in mortgage guidelines change constantly. So there's been so many shifts and changes in our career lifetime just in the last 22 years, and that's obviously going to continue. But it is, again, people have more equity now than probably ever before. So one of the things that we're looking at now is people don't want to touch those super low rate mortgages, but they're starting to rack up a lot more credit card debt because of inflation, and a lot of those credit cards are in the high teens and 20s, and they're racking them up. So now home equity loans, home equity lines of credit are a big. We're actually releasing one next week, a closed-end second mortgage where we can do debt consolidation for people,
really,
without having to impact their first mortgage and their rate on that. So that's
So if I have, can you just speak to that just a little bit more about a HELOC, right? A home equity line of credit, right? So the way I understand it is if I have a house, let's just say it's worth 500K and I only owe, let's call it 300K. I could tap into that $200,000 without necessarily, is it a separate loan? Is it a line of credit, or like, how does it work? Is it like a credit card? Or
right.
What is
it's technically a second mortgage, right? So it's a second lien behind the first lien. So your regular mortgage is a lien, and that's your first lien. A HELOC or a HE loan, they're called a lot of times too, is a second lien. So it's a second mortgage. A line of home equity line of credit, or a HELOC, HELOC, is like a credit card. The best way to simplify that is it literally is like a credit card. You can start it off with a zero balance. You can take, most places will go up to 80% of the total value of the house. Some will go to 90 or even 95%. So what that means is if you have a $500,000 property and you could borrow up to 80% of the total, which is 400. So if you owe 3 on the first, there's 100,000 in there that you can take on one of these loans.
Yep.
So, and again, some will go higher, some will go to 90, some will even go to 95% of the total value of the house. So where it's good, HELOCs are really good for home improvement, things like that, because it's like a credit card and you don't pay anything until you start to use it. So if you have it's like having $100,000 credit card. You can't get $100,000 credit card. And even though the rates are tied to prime, which is 8.5%, sounds scary. It's a hell of a lot better than a credit card rate that's 20%.
Very true. Very true.
So there is, so for home improvement, it's good because if you're doing a project in the house and you say, all right, I need to give my contractor $20,000 to start the project, you write them a check for $20,000, just like a credit card. You'll get a statement in the mail the next month with an interest-only payment, showing, okay, you owe now $20,000 at this rate. Your minimum payment is this. You can make more. You can add to the principal, things like that, and pay it down, as you go, or not. So. And those loans can be refinanced still independently of the first. So if you have a line of credit and you're getting to the end of that term, you can actually get a new line of credit to replace the old line of credit still without impacting the original mortgage, 30-year fixed mortgage that you have.
Interesting. And then when you sell the house, you obviously pay back both.
Right. Or people, when they refinance, they consolidate them into one loan,
wrap
stuff
them all together.
Right. So, home equity loan or, HE loan or however you want to, whatever you want to call it, is same idea, second lien behind the first, but it's a fixed rate in a lot of times with, another either 10, 20 or 30-year term, but with a principal interest payment. So it works just like your first mortgage, but it's a set amount. So when you have the closing, you get all of that money and you start paying it back with a principal and interest payment the same way you would pay back a mortgage. So those loans typically can be better for debt consolidation, credit card consolidation, stuff like that, because it gets people out of just paying the mindset of a minimum payment and actually paying principal and interest with an end date on it.
Exactly. It gives you a fixed amount. So like if I owe whatever 50 grand in credit card debt, I know, okay, boom, if I take this out, whatever, I'll pay $2,000 a month for the next whatever it is until I pay it off. And I know I can just budget for that 2,000 instead of all these 17 different cards.
Right. So, and what's cool about it is if let's say you have 50,000 of debt, you got to consolidate, and you took $100,000, home equity loan, you pay off the credit card, that 50 is going towards that. The other 50, now you just put cash in your bank account that you could use for future projects and stuff like that on the house too. So it's just really kind of the two different options of tapping the equity. And right now, because of the appreciation you're seeing on this graph, people have more equity than they've had probably in the last 20 years in terms of, so people's net worth has gone up substantially if they've owned a home, in the last few years. And again, it's a way of tapping that equity without impacting the low rate you have on the first mortgage.
And you guys offer both options, Loan Depot?
Yeah. We do.
How often are you having those conversations in this market?
Every day.
Hey, Christian, tell me, what can you get me? I don't want to sell, but what can you get me?
Well, and some people use it to actually tap the equity for a down payment on another house. Those are like, people refer to those as bridge loans commonly. But a bridge loan is really just a home equity loan. So you can actually take the equity out of your house, your current house, hold that money on either a line of credit or, a second mortgage. And now you have a down payment or a substantial deposit to put down on the next house.
Mm-hmm.
So, and then we can look at whether they qualify, still not keeping the old house or that they still have to sell it and all those types of things. So, there's multiple uses for the equity in the house.
Interesting stuff. I'm going to just take this chart down. I think that's all we have time for today was the home prices. Maybe next week, we'll dive into a different chart that kind of walks through the not necessarily the appreciation, but just like estimated home sales over the course and compare those two charts. Yeah,
no, we should at some point too look at those absorption rates that we've been talking about. Also, getting that slide out there and looking at buyer sellers market, affordability indexes, things like that. We can definitely get into deeper dive.
We'll do. All right, Christian, thank you so much. I truly appreciate your time, and I'll see you next week.
Thank you, man. Have a good one.
All right, take care.